You're on mute. Hey, how are you?
Good. How are you? Hey,
Good. Good
Lonnie.
to
Hey.
see you. I don't know why I didn't think to just put on my Invest Atlanta shirt. I should have. I know you repping. You are repping hard. I should have. I wasn't even thinking. I just went and snatched something out of the closet 5 minutes ago to put over this T-shirt I have on.
Okay, guys.
Totally different.
Hey, I'm going to put you guys, if you can put yourselves on mute real quick. There's 41 people in the waiting room. I'm not able to connect to live. It says I'm live, but I don't see that I'm live. So I'm going to check that out. But let me let these folks on in. See, everybody's coming in. See everyone. Okay, if everybody can put themselves on mute real quick, we'll get started. Welcome. All right. I'm hoping everybody can hear me. Welcome to Invest Atlanta's House Rules for Home Ownership, Understanding Your Credit. This is a 4-part series that's been designed to help you along your path to home ownership. Before I introduce you to the best team in the world, I'm going to tell you who I am, and then I'm going to go over a couple of housekeeping rules. I'm Michelle Lewis. I am the Home Ownership and Community Engagement Specialist for Invest Atlanta. I work in the Community Development Division. Just a couple of things really quickly before we get started. Keeping yourself on mute throughout this presentation is going to help a lot. We had over 300 people register for this. So to get through quickly without disruption, it's a good idea to keep yourselves on mute. Also, because we have so many people, it's probably a great idea to hold on to your questions until the end. We'll get through this presentation fairly quickly, leaving enough time for you to ask questions. And you'll have a couple of ways to ask those questions. So if you have a question early on, you might want to write it down. And then at the end, you can use your chat mechanism to ask that question, or you could use the raise your hand mechanism, and I will unmute you so that you can ask the question again at the end of the presentation. One last little rule. We are asking that, because we do so much at Invest Atlanta, that we keep the questions limited to the subject matter, so to the content that we are discussing. If you have any questions that you need answered by Invest Atlanta about something else, by all means, send your questions to info@investatlanta.com. I now own that inbox, so I will answer those questions or at least point you in the right direction. Okay, so here we go. I'm gonna introduce you to some of my favorite people, starting with Felicia. There she is. I'm gonna unmute you, Felicia.
Hi, I'm Felicia. I'm your mortgage loan coordinator. Happy to see everyone on the call. I think you're going to enjoy this session. So we're looking forward to working with you guys.
Awesome. All right, and then Kirsten Ryans.
Hi, good evening, everyone. Hope everyone is doing well. My name is Kirsten Ryans. I'm the Homeownership Coordinator here at Invest Atlanta, and we're excited to have you all here tonight. And I'm going to be excited to work with all of you, hopefully in the future.
Awesome. And then our awesome leadership, our fantastic director, Anita Allgood. You got yourself unmuted there?
I do. Let me unmute myself. Hi, everybody. I'm Anita Allgood, Director of Homeownership and Single Family Services at Invest Atlanta. Thank you guys so much for being here. Please bear with us as we, just like you, get used to this new normal. We don't want this COVID-19 thing to prohibit us from getting you the information that we know you need. Homeownership is still going strong. So thank you again for being here as we provide the information that you want and need.
Awesome. So I'm going to transition into sharing a screen. Well, actually, you know what, Anita?
Yes.
We need to bring on our speaker.
I'm sorry?
We need to bring on our speaker.
Yes, we do. So it is my pleasure to introduce to you Miss Bonnie Stewart. Bonnie is a producing branch manager and senior mortgage loan originator at CalCon Mutual. Bonnie has been originating loans for over 20 years and doing DPA loans for equally as long. She has a 98% pre-approval to closing ratio over the last 20-year span. And she is now a first-time homebuyer presenter for the last 4 years with Urban League and 8 years with Fulton County Housing Authority. And so again, Bonnie is one of our favorite loan officers. She has been participating in our program for many years and is a top producing loan officer for our programs year over year over year. So let me please introduce to you Ms. Bonnie Stewart with CalCon Mutual.
Good evening, everyone. I would like to thank everyone for joining. It's a very important topic, credit, not just for securing home ownership, but for a quality of life. Nowadays, credit affects everything. It affects not only where you live or what you could purchase, it even affects certain jobs. You know, I had a friend that applied for a job at a company and they offered him the job subject to credit check. He did not pass the credit check, so you know what happened to the job. The offer was rescinded. So credit is a very important topic. It's best that you understand it. It's just like anything in life. If you want to win in life, you've got to understand the rules. And I like to say credit is a game. And so understand the rules of the game in order to win and to win at life. Credit has sustained me. I've been on my own since I was 17. And credit, I understood the importance of credit and I have kept my credit together. And that is what got me through life, or is getting me through life, is good credit. So in the absence of having rich relatives, the credit is the key to a better life. And anyone can go from bad credit to good credit in a fairly quickly span of time. You just got to know what to do. So today we're going to keep it based on homeownership. So Michelle, take it away. Michelle is my banner for tonight. All right, so again, house rules for homeownership. June is homeownership month. So it's a great time to purchase a house. Anytime is a great time to purchase a house. And especially right now, even though we're in the midst of this pandemic, interest rates are low. There's still plenty of free money. So if you plan on buying a house, as long as you have a job, you can still buy a house. Go ahead, Michelle. As Anita said, I've been doing down payment assistance programs for my 20-year career. I do a myriad of programs and proud to be an Invest Atlanta Platinum producer for their programs, know all of them, and really promote them because they're such great programs and they're available to everyone. They're not just based on first-time home buyers. So they have an array of programs spanning different income levels as well. Next, Michelle. All right, the first step is check your credit. So you can do that in several ways. You can obtain a copy of your credit report from annualcreditreport.com. It is free, but it does not give you a score. So you can get a free credit report, but there is no score associated with it. If you would like to get your credit score, do not go to freecreditreport.com because it's not free. And Credit Karma scores are not the scores that we use in the mortgage business. They're usually much higher. And I know that's to a lot of you guys dismay, but the Credit Karma score is usually a lot higher than what the mortgage scores are. So go to annualcreditreport.com. You get your free credit report, check it for any inaccuracies, check everything on it. Check the way your name is spelled, check where it says you live, and check the accounts that are on it. Now, if you would like a score, you can go to myfico.com, M-Y-F-I-C-O, myfico.com, and get your credit report with a score that you pay for. And I believe it's very reasonable. So when you pull up your credit report, make sure you deal with any inaccuracies, take care of any disputes prior to applying for a mortgage, because when you have disputes on your credit report, we have to have you remove them and pull a new credit report. So it's best that you get it removed. And it's really best that you really work on your credit before you apply for a mortgage, because what happens is when you apply for a mortgage and we pull your credit, there is a thing called a trigger pull. And what it does is triggers and alerts anyone that you owe money to that you think may have forgotten that you're now applying for a mortgage. And guess what? They know that's the best time for them to collect their money. So they will then put whatever information, the collection on your credit report. And that's why a lot of people say, well, I haven't heard from them in years. And, you know, now I got a collection on my report. That's why, because it's a trigger pull, because they know that's the best time to collect. So it's best before you even go to a mortgage company or apply for a mortgage loan that you deal with your credit report and make sure it's straight before you go. Next slide, Michelle. All right. So again, we talked about credit being a game. So we have to understand the rules of the game. There's 5 major factors that make up your credit score. And of course, what is the biggest one? 35% is payment history. And that's just simply, do you pay your bills on time? So that loan that you took out, that you made an agreement on, that you said you would pay them on the 15th of every month, are you doing that? That's payment history. And it has the hugest impact, because why would we think you would pay your mortgage on time if you're not paying your current debts on time? So payment history makes up 35% of your score. The second biggest impact to your score, 30%, is your credit balance. Now, this is one of the areas in which you can make the biggest changes to. And that credit balance is what's on your installment loans, as well as what's on your credit cards. So, and how much do you owe? Are you maxing out your credit cards? If you are, you're lowering your credit score. So the quickest way to get your credit score up is to pay down them balances on those revolving accounts. And again, revolving accounts for things like credit cards, those are your revolving accounts, and they fluctuate every month. So if you check your credit report one month and then the next month your score is lower, check the balance of your credit cards, because you may have charged it up. And sometimes as little as $5 or $10 can tip the credit score in terms of what your credit score will be based on that balance. Next is your credit history, okay? How long have you had credit? So if you're looking to increase your credit score, do not close your old accounts, all right? And if you don't use them anymore, you want to try to use them at least 6 months to keep them open every 6 months. And a lot of times the creditors will tell you, hey, you haven't used this. If you don't use it, we will be canceling it. So you want to make sure that you use those accounts and that you have long credit history, all right? Because that's the third biggest impact. Next would be the type of credit. And that's a mix of credit. Like, do you have credit cards? Do you have you applied for new credit? It's just a total mix of the credit. So the type of the credit also has an impact. And then last would be your inquiries, any new credit, because a lot of times initially new credit can lower your credit score until you have a payment history. And then sometimes, depending on what it is, it can up your credit score. So that just varies. And what are the different inquiries that you have out there? Too many inquiries will drop your credit score. Next slide. What's a good credit score? Of course, we know 800 to 850 is exceptional. With that credit score, you can get anything you want. I think one of the biggest misconceptions is most people think most people have bad credit, but that's not true. As this says, 67% of Americans, they do have good credit. So, oops. Can we go back? There you go. All right. So if your credit score is between a 300 to 579, that's very poor credit. And it's just going to be almost impossible for you to do anything with that credit score. But again, remember what I said, the good news is you have the ability to get that score up. And for most people, you can get it up really quickly. You just got to know what to do. Fair credit is anywhere from 580 to 669. And I'm sure a lot of you guys are aware with the pandemic that a lot of lenders have upped their credit score to a minimum of 660. There's still some doing below. We will, but there's a negative impact to that in terms of having to pay discount points and things like that to get the rate. So, and that's only on FHA loans. But between 580 and 669 is considered fair. Now, most lenders, again, would prefer at least a 620, and a lot of people are at 640 or above. So it's best to try to get, in today's environment, your score up to a minimum of 640 when it comes to a mortgage. But check with your lender to determine what their score requirement is or what they have seen in terms of approval. Like Fannie Mae says that, you know, everyone that are on a conventional loan, you can get a conventional loan with a 620 credit score. I had yet to see that happen. So I'm hard pressed to see it happen nowadays with a 680 credit score. So again, the higher the credit score, the better. Good credit falls anywhere with that 670 to that 739. Very good is 740. 740 and above is where you see a lot of the offers with the very, very low rates. And of course, most of those are with a nice down payment. But when you see a lot of the low interest rate offers, it's pretty much in that very good credit range from that 740 to 799. Again, when you get to 800, you can pretty much call the shots. You're eligible for everything you see out there when you hit that, or even pretty much at that 740 range. So as you can see that 25% of Americans are in that 740 to 799 range. And there, it also varies across the United States in certain sections of the country. There tends to be some areas that have lower credit scores. But this is what a good credit score is. And it's important that you understand where you fit on this wheel. Okay, next, Michelle, please. All right, let's talk about how it affects you. Okay, so when you're in this poor range, you may be required to pay a fee. You're going to be required to pay a deposit to get utilities. Everything is going to be much more challenging when you're in this 300 to 579 range. And for most lenders right now, you can't even get a mortgage in that range. 580 to 669 is considered fair, but you're considered kind of a subprime. But again, at a 660 or even a 640, you can pretty much get a decent interest rate. And in today's economy, every rate is a good rate. So in the fair range, again, you're not considered prime, but you're still a good candidate and you are eligible for FHA loans with most lenders. 670 is 739. This is now you moving into the good range, which means that you're eligible for a lot of the programs out there for the better credit score, for the better terms, be it with a mortgage or with anything else. And then again, we have the 740 to 799. That's very good and exceptional. So the ones with the very good and exceptional are the top tier borrowers who, again, can do the conventional loans, 3% down, and receive excellent interest rates. Next slide, please.
Hey, Bonnie, can I ask a question?
Yes.
We do have one question that has come in. It says, what is the typical range between Credit Karma and the mortgage pool? I'm not sure what the mortgage pool is, but.
Well, I think they're saying, what's the difference in the Credit Karma score compared to the mortgage FICO score when you're comparing them? So pretty much I have found Credit Karma to be 30, 40 points higher. So what I tell people, don't use that score as a basis for going to get a mortgage. Use that score as a basis for improvement. So find out, so if you pull Credit Karma and it says you're at a 600, okay, and you're working on your credit, because the Credit Karma is free, and you're working on your credit, so look to see how you move from a 600 to a 620 or 640, because, you know, we move in 20 increments, 20 points increments on the interest rate scale for the most part. So look to see what are things that you're doing and what direction you're moving in, and keep moving in that direction. Okay. Or what you could do is, once you get your FICO score, and it's important that you do this at the same time because credit scores are fluent. So they change every day because there's a whole host of information being pulled in for the credit score. So they're fluent. They change daily. Okay. You could go to one lender and have one score, the next day go somewhere else and have a different score. So that's important to understand. So when you pull your Credit Karma score, also pull your, if you're going to go to My FICO and you pull that report, now you have a basis to track your improvement. You don't necessarily have to pay for credit monitoring unless you just want to, but now you have a basis because you can keep going on Credit Karma and you can track it to see what the difference is. And then it'll give you an idea of where you may be once you got to score X number of points. Okay. All right, 8 tips for boosting your credit score. Well, first you got to review that credit report, making sure the information is accurate. Now, a lot of credit reports have errors on them. And, you know, most people just focus on the score. We focus on the score, what makes up that score? What is that body of information that makes up that score? You could have a great score, but that doesn't mean you're going to get a loan because it depends on what made up that score. So there are certain things that can negatively impact you as well. But review your credit report and make sure your name is spelled correctly because there's a lot of name errors. Make sure the addresses are correct where you live because we look at all this and you have to explain all this to us as well. Look at where it says you lived. And I would have to tell you, when I look at people's credit reports, and sometimes when there's fraud on it, a lot of times it's from family members who have access to your information. So just make sure you're checking your credit report, especially if you live with a relative, because I've seen that so many times. Set up payment reminders. If you can't remember to make your payments, then set up payment reminders. Everybody has a phone, so you can set up the payment reminders once a month or do bill pay through whatever institution that you bank with. Pay more than once in a billing cycle. That will help too, or even get ahead of it. If you, again, a person who is managing your bills by your pay date and they don't quite align, then maybe you need to get 1 month ahead. Contact your creditors. It's best if you know sooner than anybody if you're not going to be able to make your payment. So rather than waiting and being late, contact your creditors ahead of time and let them know and see what they can do. Sometimes they will help you and not report it late. So contact your creditors before you're late. Limit applying for new credit. Only apply for credit if you really have to, because again, initially it may lower your score, but over time it will increase it depending on the type of credit it is. Do not close unused credit card accounts. Again, we talked about that. Make sure you use those credit cards at least every 6 months or they will be closed. The creditor will close them. And credit history is 15% of what makes up your score. So it's very important that you keep that history. So don't close those credit card accounts. Be careful with paying off old debts. This is a mistake a lot of people make. They'll pull out their credit report and then say, okay, well, I'm gonna pay off all these old debts and it's gonna increase my credit score. Not necessarily. A lot of times it lowers your credit score Because what you do is you go back and you reactivate old debts. Okay, so if that debt is on your credit report and it's been sitting dormant, and you look at it and it says last reporting date was 2-3 years ago, why go mess with it? So do not go paying off old debts unless you talk to the lender and the lender advises you to do so. Now, I know for me, a lot of times, if there's a debt that needs to be paid off, such as an old apartment complex or something like that, our apartment complexes, we do require you to, for the most part, pay those off. I'll have you pay it off closing because I don't know what impact it would have on your credit score. So I'd rather not mess with your credit score while we're in the midst of the process. I would rather you pay it off at closing, then I don't have to worry about that. Pay down maxed out credit cards. So your balances on your credit cards have the biggest influence on your credit score. So I had a client who had a $300 secure credit card, and I had her pay it down to 10%, not zero, because zero doesn't always get you the best score. She paid it down and her score went up, I think about 35, 40 points. So the credit cards have the biggest influence in which you have control over to increase that credit score. So look at where your credit card balances are. Start with the one where the least amount can make the greatest impact. So if you have a $300 credit limit and you're at $100, pay that down to $70 or less, but not zero. All right. And then move to the next one. So start with the ones that has the greatest impact based on your availability of cash, your available cash, to get them down close to the 10% or less range when you are trying to increase your credit score. All right. One other thing you can do, if you know somebody, they love you, they trust you, and they have a credit card with a low balance, have them put you on as an authorized user, so long as that particular card company, and not all of them do, will report authorized users. But that's a great way to increase your credit score as well. And then with your score up, you can go apply for your own credit card and have more likely to get it. And then you can release yourself as an authorized user. So, next slide. Student loan debt. This is one area that is really impacting homeownership, is the student loan debt. Student loan debt in the US has reached over $1.5 trillion. That is huge, huge. And I see a lot of credit reports with student loan debts, $200,000, $300,000. And it's just amazing to me, that amount of debt for student loans. Now, one of the biggest mistakes people make with these student loans is they defer them forever. And that's just increased your debt obligation. Next slide, please. So student loan debt is jeopardizing the American dream. Ever since FHA about 5-6 years ago came out and said, no more deferment, no more forbearance. We're going to count a payment no matter what. That has dramatically impacted home ownership. But you have to understand why they did that, because eventually you're going to have to pay those student loans back. And how is that payment going to impact your ability to make both the student loan payment and your mortgage payment? That is one of the reasons why FHA made that change. But it's jeopardizing the American dream. You have 56% of people with the student loan debt struggling to buy a car, 50% can't buy a house, 41% can't open up a credit card, and 49% of the people delay getting married or engaged because they have just so much debt. So it's important that you get a grip on the student loan, and there's lots of things that you can do in regards to your student loan debt. Now, one of the things that you want to look at in terms of your student loan debt, depending on your credit score, because I know there's a lot of people out there in those income-based payment repayment plans, they call them IBR, income-driven, pay-as-you-go, all those different types of plans. Now, those only work with conventional loans. So if you are not in that higher credit score category, you're probably not a candidate for a conventional loan. So you would have to pay 1% of whatever that balance is. So if your balance is $100,000, we will use 1% as your payment on an FHA loan, and that would be $1,000 a month. And I know most people can't carry their other debt and a mortgage with paying $1,000 a month in student loans. So you're like, well, what do you do? Well, you have two options. One, you can work really hard to get their credit score up so you can do the income-driven plan. Or two, try to get your student loans in a 25 to 30 year fully amortized extended payment plan. Those are your two options. Because for most people, the fully amortized regular plan is not enough. But if you can go 25 to 30 years, in which I have seen that quite a bit, then that really helps lower that monthly payment on the student loans. Now, another question I always get is, well, I'm in the loan forgiveness program. We don't care. We need a payment, period. Because you could quit your job, then there goes the loan forgiveness program. So we need a payment no matter what. I'm gonna say that again. We need a payment no matter what, all right? Now, the caveat is if you're a veteran, VA still will allow you to deferment. So that's an option for veterans. Next slide, please. 3 ways student loans affect credit. Well, you know, there was the Credit Card Act that was passed. I can't remember what year it was, because remember, you had a lot of kids in college getting all these credit cards, you know, and so Congress passed a bill that says, you can't do that until you're 21. But, you know, you can jumpstart your credit with the student loans. Now, part of the problem with the student loans and credit is that when people do come out of school, they forget they got to start paying. And so what happens is I initially see when they come out, they forget the time frame, and now they got late payments with the student loans. And that will really tank your credit score, all right? So it can, student loans can jumpstart your credit. And what I always tell clients that pay something, just pay something, doesn't matter what. It's just gonna amount owed is impact. Go back. Amount owed, your score typically falls immediately, but goes up when you start making payments. And the other thing is, so you want a mix of makeup or different types of credit on your credit report. Next slide, please. Student loans, a single student loan payment that's 30 days late can cause your credit score to drop by over 80 points. That's huge. So it pays really to pay attention to those student loans. Again, I see a lot of student loan late payments. I mean, 30, 60, 90, it just tanks your credit score. So you really, really, really got to pay close attention to that student loan debt. Sometimes people say, well, it was getting consolidated. Just keep making your payments until you get the letter in the mail that said it is complete, because the impact it's going to have on you is huge. And it goes far beyond just the student loans. Again, I talk about credit and quality of life because it does equate, okay? The higher your credit score, better access, just makes life easier. Better access to credit, and everything you do that involves money and credit is easier, much easier with a higher credit score, okay? Student loans and COVID-19, what you need to know. So the CARES Act, which was signed March 27 and covers the federal loans, federal payments are automatically on hold from March to September. Is automatically on hold. Interest on the loans will remain at 0% during this period. Federal loan debt suspended, not eliminated. Again, it keep adding up. Pausing federal loan payments will not affect your credit score. I would suggest that you still check with the student loan provider. Make sure you understand what they're doing and what you need to do. I wouldn't just go by, what Congress said. I would check and make sure that you know exactly how it's going to impact you if you suspended your payments. Okay, next slide, please. Additional changes to COVID-19 is interesting. I just saw this on a credit report I pulled 2 weeks ago, and it said natural disaster code. And I was like, natural, it has to be the pandemic. So, and so this is a statement that's being now put on credit reports. And this was for a car payment. So I called a client and said, what is this natural disaster code? He said, well, they called me and said, if I wanted to, you know, not make my payments for the next 3 months, that I'm eligible to do that. And my question to him was, were you impacted by the pandemic? Were you laid off? Was your income impacted? And the answer was no. So my question to him was very simple. When an underwriter sees this on a credit report and you're applying for a mortgage to purchase a house, we're naturally going to think you're impacted. So why would we give you a mortgage during this time? I think that's a very simple and very fair question. So I know for us, my company, we are having people fill out a statement letting us know if they've been impacted or not. And if they're currently impacted, we're probably not going to give them a loan. Because if you can't make the rest of your obligations, how can you take on a new debt? So when you're doing this, think about it in those terms. Make sure that you also understand what are your options. And it's going to vary from creditor to creditor what it is that they're doing. So make sure you get the details, okay, and understand how it will impact you and your future purchase or whatever it is that you're trying to do. Because I know there's a lot of people taking advantage of this that have not been, their income hasn't been negatively impacted. So just be very careful if you take advantage of any of these payment deferment options, all right? Next slide, please. All right, so let's talk about debt to income ratio and why is it important? Well, next slide, please. Your debt to income ratio is how everything is calculated, okay? So in terms of a mortgage, we look at this to determine how much we can qualify you for in terms of a house payment. Now, I like to tell people that what you qualify for and what you can afford can be two different numbers. Because I can say you can qualify for a $1,500 mortgage, but you're looking and you're paying $1,200 and you only got $5 left at the end of the month. So maybe you can't afford the $1,500 that you qualify for. So it's up to you to understand what your affordable number is. And only you can do that. You know what's going on in your life. You know if your car is about to go out or you need a new transmission. You know all these things. So it's important for you to understand your affordable number. And when you look at what you're paying for your housing expense right now, and you look at your lifestyle and you're looking to move up, let's say if you're paying $1,200 and you do want this particular house is $1,500 a month, or you know that sales price puts you in the $1,500 a month category. So you want to at least start saving $300 a month. And if you can start saving $300 a month for the next 4 or 5 months, then maybe you can go from $1,200 to $1,500. But if you can't, and at the end of the month, you got $20, $30 left, then maybe you need to stick to the $1,200, or maybe you need to go down to $1,000. So that number, it's a very individualized number. So I challenge you to go look at your bank statement, okay? Because your bank statement tells a story about you. And understand that the underwriter doesn't know you, never will speak to you, but this is what they're going to base your approval on. All the flow of paperwork that is seen and analyzed. So take a look at your bank statement and figure out where you can cut if you want to go from $1,200 to $1,500. And then once you can do that, then you can move forward. So your debt to income ratio is all about that. What are your monthly debt payments? And we look at the items that show up on your credit report. So it's your monthly debts divided by your gross monthly income equals your debt to income ratio. Next slide, Michelle. What's in there? We include your credit card debt, your installment loans, your student loans, your personal loans, maybe you got furniture, your student loans, auto loans, any judgments, child support, alimony that you pay. Those are the debts that we calculate into your debt to income ratio. Then we look at also, okay, what is this new proposed housing expense? You know, the mortgage, the principal and interest on the mortgage, the property tax, the homeowner's insurance, if you got to pay an HOA fee or a condo dues, we calculate all that into your debt to income ratio. And for the most part, depending on what type of loan that you're doing, be it conventional versus FHA, there is a cap. For most conventional loans, the cap is 45 to 50% maximum debt ratio. FHA, depending on what you look like, you could possibly go up to 55. Now, even on conventional, even though they have a cap, that doesn't mean you can go all the way up to the cap, because we're going to run your loan through what's called the desktop underwriting system or loan prospector, and it's going to tell us where to cap you at. Because sometimes we might be at the max and we have to keep coming down to get an automated approval. That's the approval through the computer. So even though on the face of it, the cap is 45 or 50, again, it depends on you. What does your total file look like in terms of credit, in terms of income, in terms of assets? Assets is the liquid cash that you have available, be it your retirement or what's sitting in your bank account. And that has a very big impact, especially if you know you're borderline with your credit. It has a big impact on whether or not your loan can get what we call an automated approval. Next slide, please. All right, so again, we continue on with the debt to income ratio. So this person makes $62,000 a year, which is $5,167 a month. We take their revolving debt, the minimum monthly payment of the revolving debt. So we have a car payment of $308. They pay $120 towards their credit cards monthly. They have a student loan payment of $203, a furniture payment of $45, and we're incorporating a mortgage of $1,500. And so when you do the calculation, their debt to income ratio is 42%. So they fit within most of the guidelines in terms of max debt to income ratio. Now, another way I like to do the debt to income ratio to arrive at the reverse is take your gross monthly income and just chop it in half, 50%, or chop it or take 45% of it. All right. And then, excuse me, then make a list of all the stuff that shows up on your credit report, the car payment, the credit cards, student loan, and the furniture. Okay. Once you have that number, subtract it from that 50% number, and what's left is what can be applied towards a mortgage. So we kind of doing the reverse to see what your maximum mortgage amount would be in terms of qualifying purposes based on the 50% debt to income ratio. So again, we're going to take your gross income, monthly income, we're going to chop it in half. So if it's $5,000, we're at $2,500. Then we're going to take the debts that show up, the monthly debts, the monthly payment that show up on your credit report. We're not going to count your cell phone bill, your car insurance, utilities, none of that. Just the things that show up on your credit report. And we're going to subtract it from that $2,500. And let's say it's $500. We have $2,000 left that can be applied towards the mortgage. So that's a reverse way to do it. And all that is your debt to income ratio, which is what lenders use to determine your qualifying purchase amount for a home. Next slide, please. What are the benefits of saving money and having reserves? I should put an S on that. Savings. Savings is always a great thing. You won't have to worry if you're hit with an unforeseen expense because you're prepared. You'll have a financial backup in place if you lose your job. I got a call from a client and said, Ms. Bonnie, I understand why now you saying save, save, save. And she said, I've been saving. So when this hit, she's like, I'm good. You'll be prepared if your circumstances change because, you know, this is life. It's fluid. It's constantly changing. We just never know what's going to come on our path, good or bad. So again, savings, it's just wonderful to have it. I know for me, it gives me a sense of calmness and peace to have some money saved. You'll have money for mortgage reserves. That's a great thing because when you have reserves and you're borderline, it sometimes makes the difference between an approval or not. Okay. So what is mortgage reserves? Cash reserves for future mortgage payments. That includes your principal, interest, taxes, and insurance, and if there's an HOA fee. It typically is required for lower credit score borrowers. 2 months is the average required amount. Most lenders are looking for 2 months, or like I said, when I run it through the desktop underwriting system, sometimes if I don't get an approval, I'll just fudge and put in 2 months of reserves and boom, now I got an approval. So then I'll go back to the client and say, okay, that mortgage payment is $1,000 a month. You need to have $2,000 after closing. And yes, we can use your retirement account, your money market account, any short-term highly liquid accounts to qualify as cash reserves, plus, like I said, the retirement. So again, assess your situation. If you're borderline, you need some savings. You need these reserves in order to push you over the top. Because for a lot of people, that is the only thing that pushes them over the top. Other than that, because again, because first payment default is real. A lot of people don't understand that. There's a lot of people who buy a house and never make the first mortgage payment. So reserves are a great way for lenders to know that at least you can, you know, make your first payment. Because when you buy a house, a lot of times there's a lot of expenses associated with the move-in. So we like to see that you have at least 2 months liquid reserves. Next slide, please. Did I make my 45 minutes? Oh, record time.
You did. Great job, Bonnie.
Thank you. I think I covered all the topics.
We actually do have some questions, so I'm just going to read them out to you and let you answer them. Okay.
All right.
So the first question says, I have no debt. I have one open account, which is a Kohl's card with a $1,000 limit and a zero balance. I don't want any open lines of credit right now. Can I use my credit history as is without getting more open lines of credit?
You only have one account. How many credit scores do you have? That's one of the questions.
So the question would be, how many credit scores do you have? When you go to pull the credit, you're expecting to see 3 credit scores. And if they don't have 3 credit scores, what then happens?
Then we make up for that with your rental history. We can use a utility bill. So we try to support your creditability by using what we call alternative trade lines. So we first look toward, well, what has your rental history been like? And then we would look to get a 12-month rental history. Hopefully you're paying to a third party, you know, as opposed to a private landlord. So we look for that history and we add that to your credit report to supplement it. And then we also ask you to give us like a utility bill. And so we would use those items to supplement your credit.
So then we're saying that the probable answer to that question is no. She would not have to get open any additional credit lines because you would use the alternative credit.
Correct.
To help strengthen her credit scenario.
That's correct.
Okay, awesome. Okay, next question. Does receiving credit card limit increases negatively affect your credit?
It depends. In the short term, it might, but in the long term, no.
Okay. Next question. I had a creditor close my credit card for not using it, and they put the account they indicated that the account was closed by me. Should I dispute this so it says it was closed by them?
I don't think it's going to make a difference.
Right.
So I wouldn't add a dispute.
Okay. You want to talk a little bit about disputes on credit reports and how that's going to impact your review, the lender's review of credit?
Yes. When you have disputes on your credit report, it impacts your credit score. We don't know if we have a real score or a false score because of disputes. Now, there was a time period when loan officers would tell people, or even credit repair companies, go dispute everything. And the reason why they would tell people to do that is because when you do initial dispute with a creditor, the credit agency has to pull that information out of your credit score. So your credit score would artificially be higher until, it gets resolved and we know what's real and what's not real. And so as a result, lenders became aware of this, and so the guidelines was changed as a result, because we knew that the credit scores that we were getting were not real. And so now when you have a dispute on your credit, we have to have you get the dispute removed and pull a new credit score, a new credit report, so that we can know actually what the score is.
Exactly. Okay, next question. What are the different FICO scores mean? What did the different FICO scores mean?
In terms of what? In terms of the actual score? In terms of like?
Well, I mean, I think that is in reference to the different agencies, I would imagine, that create the FICO. I'm not exactly sure.
Okay.
So go ahead.
So there's FICO, there's what? Fair Isaacs? Fair Isaacs. Yeah, there's different ones. And they just basically are what the Experian versus Equifax versus TransUnion is, basically. And now, there's that Advantage score, but nobody uses that. Here in the South, Equifax is most widely used. Now, you have to be careful also because, well, not careful, it just is what it is. When it comes to credit scoring, there's different versions. Like there's Windows 8, 10, same thing. When it comes to the different credit scoring models, there's different versions. And some of the versions can be slightly different in their reporting. So again, if you are trying to do a comparison, you might want to ask the question of which version are you using in terms of each of the three major ones, because we pull Equifax, TransUnion, and Experian. And if you see a huge variation and it's all on the same day, you might want to just ask what version they're using.
Okay. All righty. Is there a way to get 2 late payments off of your credit report due to being in the hospital and paying after the due date for 2 months?
That's going to be totally up to the creditor. I mean, it's worth a shot, especially if you have had an on-time payment history for the life of that loan, and this was a life circumstance that caused this, and not just negligence on your part. It's worth a shot. I certainly would ask.
I agree.
It's going to be the creditor's discretion.
Okay. If all of your credit cards are paid off, do they still consider the credit card minimum payment in the DTI calculation?
No, not if your credit cards are paid in full and it's a zero balance. We do not put it in your DTI.
Okay. And so when is that number always a number?
When it shows up on your credit report.
Right. But student loans, even when there's not a number.
Oh, it's a number. It's 1%.
You're going to calculate a payment. You want to talk? Did you talk a little bit about that?
I did.
Okay. Yeah. Gotcha. Okay. Next question. Do you check the money in the account for that? I'm not sure what that means. Do you check the money in count for that?
I'm not sure what that means.
That maybe have something to do with liquid assets. The money in account?
We verify all assets based on what you put on your credit report. I mean, on your credit report, on your application and the bank statement.
Okay. How long do you have to be employed on your job?
It depends, but for the most part, 6 months. I just had someone call me and they were concerned because they were a student. We use your transcripts as part of your employment history.
Okay. How do lenders look at a situation where your credit has been negatively impacted from past accounts that have either been paid off or are caught up and currently on time?
That's already factored into your credit score. So it's factored in your credit score, but it depends on when were you last delinquent, because we look very strongly at the last 2 years and more importantly, the last 12 months as well. So if you have been delinquent within the last 12 months and you don't have a good letter explanation and your credit is not strong, you may not be able to get approved. Or you have to have what we call compensating factors, and where it balances itself out. You know, compensating factors would be you got a lot of reserves, you know, you're putting down a big down payment, things like that.
Okay. My charge-off accounts still show my credit card utilization at 100%. These accounts have been closed for 5 years. Do I pay off to higher the score?
No, you don't pay charge-off accounts.
Okay.
If they're charged off, go ahead.
Go ahead. No, go ahead. Go ahead. You have
If
something
they're
to
charged
add?
off, we're not counting any of that information, your debt to income ratio, and the impact of it being late is already there.
Okay. I sold a house 5 years ago. I have lived with my mom since. I guess maybe her rental history. How is her rental history maybe going to be showed? She doesn't really have any because she lives with her mom.
Well, it depends on if she's paying her mom, but you know, we always have lived with a relative. Now, if your credit is good, it's not going to matter.
Okay. Is there a preferred way to dispute items on your credit report? For example, disputing an item online versus with a written letter.
It is my understanding that there's a difference between the impact of the two and your legal rights. So I would Google or go to Fair Credit Reporting Act and put that in there, because there is a difference between online versus written. And I believe you give up some of your rights, and don't quote me on this, but you have to do your research when you do it online.
Okay. So I don't have rental history. So I guess the question is how does that impact their ability to buy a house? They don't have rent. I think you just answered it, but.
Yeah, if you don't have rental history, again, it depends on the rest of the makeup of your file. We're going to ask for rental history when your file is borderline, okay, to show your history of making housing payments. But if your credit is not borderline and you got reserves, we don't even ask you for rental history.
Okay. Do you recommend paying off all or most credit card debt before applying for a mortgage?
I would advise that if your credit score is low. If your credit score is not low, then no.
Right. So wait, and let the lender kind of tell you what you need to do.
Right. But if you're maxed out at most of your credit cards, then please do that.
Yeah. Can one spouse get the house in their name if the other spouse has late credit cards?
That one spouse will be the only one on the credit application. We do not look at the other spouse. Georgia is not a community property state.
Right. And so that also means that one spouse on the application, that's the only income you can use to qualify.
Correct. Yes.
Okay. Can you speak more about the cons of renting from a private landlord?
Well, if your credit is borderline, or if you need to produce a trade line, if you rent from a private landlord, you would have to give us 12 months canceled checks. A lot of times people pay and they're like, oh, I have a receipt. I'm like, well, I can give you a receipt.
Right.
You
have to have proof of those payments.
Proof of it. And proof it is directly from the landlord to your account.
Right.
So go ahead.
No, and so I was going to say, and so the big difference is in renting from a third party. If someone is renting from an apartment complex, the lender is going to request a verification of rent. And so that third party is going to verify that that rent has been on time. If you're renting from a private landlord, you don't have that option. The bank is not going to take that statement from a private landlord the same way they're going to take it from your leasing office at an apartment complex.
That's correct.
Okay. So what has been your experience with goodwill letters, quote unquote, goodwill letters to remove late payments after you have done all you can do to improve your credit score?
It's a wild card. Depends on who you get on the line. I tell people you have to be diligent. You just have to keep calling. I know one time I was calling on behalf of a client years ago, and I would write down who I got on the phone. And if I called and that same person picked up, I'd hang up until somebody new picked up the phone. And so I spoke to a person and I explained the situation because it's all a human experience. And what had happened with this particular person, it connected with the person on the other end of the phone. Mm-hmm. She said, you know what, I'm going to remove this. I can't guarantee it's going to stay off, but for now I'm taking it off. And the person was able to close on their home.
Wow. Okay. So we have another question about FICO 6 versus FICO 8.
I don't know. I couldn't tell you unless I did the research to tell you the difference between the two.
I'm not sure either. Okay, so typically when an inquiry ages off your credit report, how many points does one score improve, or does it even adjust at all?
Your credit scores are fluent, and for the most part, it's my understanding with some of the inquiries, it's 12 to 24 months for it, because inquiries can reduce you by, I think, 2 to 4 points or 2 to 5 points. It just depends. So is my understanding after that, because you also got to understand that as your credit continues to age and you continue to make payment, it's going to consistently improve over time. Mm-hmm. So it's hard to give you a pinpoint number. I don't know.
Okay. For the last 5 years, it was hard for me to find full-time employment. I've worked here and there. For the last 6 months, I worked full-time and saved $8,000. I was laid off due to COVID, but found another full-time job in the same line of work. How long do I have to wait before applying for a loan?
It just depends on, you worked here and there, but you were working consistently. So it depends on the gaps in between each employment. So that's going to make the difference. Doesn't have to be the same line of work, but what are the gaps and how long are the gaps?
Okay. I have multiple good standing accounts that are not being listed by Equifax. How can I have them added?
You can ask the creditor to report it. Only if the creditor chooses to report it, will it get reported.
Okay. Another FICO 8 question from the same person. We may have to unmute that person. Is FICO 8 used for auto loans and mortgages?
I have no idea. I'd have to go and look and see which version the particular company that we use which version they're using. I don't know off the top of my head.
Okay.
Because at the end of the day, it is what they're using. So, yeah.
Right. Do the money in your accounts help in your credit history?
Doesn't help in your credit history, but it helps in your ability in terms of reserves. And that's a big deal. Reserves are a big deal.
Okay. For the mortgage reserves, can money in stocks count?
Can money in stock, so long as you can show how you can liquefy them, we would need to know that. So yes.
Okay. What about self-employment? Do they look at your business accounts?
No, we do not look at your business account unless you're trying to use that money towards the purchase.
Okay. What is considered a strong credit score?
I would say a 740 is considered strong.
Okay. What about folks who have become gig economy workers, the layoffs after the market crash? Can they get qualified if their FICO score is above a 700?
Depends on the consistency of those gigs.
Okay.
Because, you know, like now Atlanta is becoming the whole Hollywood of the South. So I get a lot of people now, well, not a lot, but I'm getting more than I've ever seen before, who are working certain sets. Okay. And so they're with different production and casting companies and things like that. So now we're looking at the body of the work, the body of the jobs.
Right. Okay.
So, same thing with gig work.
Does getting a personal loan to consolidate debt help or hurt a credit score?
Help or hurt? Well, you're closing down some debts. If you close them, it just depends on how you're doing it. So it could, yes or no, it could go either way.
Right.
Mm-hmm.
Okay, my FICO score is 692, but I have a Georgia Department of Revenue lien on my credit report. How does that impact me securing a mortgage loan?
If you have a lien, you have to show the IRS payment plan and that you have been paying for a minimum of 1 year if it is a lien. Well, it depends, and then also it depends on conventional versus FHA. So yeah.
So this one says, can you stack down payment programs? Can you use Invest Atlanta in Gwinnett County? So I will tell you that our third house rules, I believe it's our third house rules, will be on Invest Atlanta incentives, and we will talk all about that. But I'll go ahead and answer that question now. We generally will layer with Atlanta Housing Authority. That is the most popular layering scenario, is our money in Atlanta Housing Authority's funds. And our incentives can only be used inside the incorporated city limits of Atlanta. So they cannot be used in Gwinnett County. Okay. What is the minimum credit score you need to buy a house?
It will vary based on the loan program and the lender. Some lenders now are at a 660 minimum. So again, like I said earlier, it's not just about the credit score. What about your debt to income ratio? When was your most recent late payments? So there's more to go into it. You could have a higher credit score, but if you've been late in the last 6 months, you may not be getting a loan. It just depends. It depends on the total makeup of the file.
Okay. What is considered a good reserve amount to make up for the borderline credit score?
I would say if it's really borderline, I would say 4 months.
4 months of the monthly mortgage payment.
Correct.
Mm-hmm. Okay. Is the 1% of the student loan used for saving or DTI?
The 1% is the calculation of what will be applied as your payment if you're not on a fully amortized payment plan for FHA. If you're on conventional, if you're not on an income-based or income-driven plan or a pay-as-you-go, then we'll use the 1% on conventional as well.
Gotcha. All right. Does Cash App count as a receipt to a private landlord?
It can, so long as it's consistent. Yes.
Okay. So I guess this was about the gig income. It was consistent. It was not consistent. Gaps were for months. So if they had month-long gaps in their employment, you would need to see 6 months consistent before they would be able to?
Yes, 6 months consistent, yes.
Yeah, 6 months consistent employment before you could qualify. Okay.
Right.
If I write a goodwill letter and get a response stating they're unable to remove past late payments because they're a furnisher of credit, then is there a workaround?
It just depends if we can, okay, so it depends. I mean, as far as the workaround is going to be, are we able to approve you with the automated underwriting system, or do you meet the guidelines of a manual underwrite? That would be the workaround.
Mm-hmm. Okay. Would you consider FICO scores generated by credit card companies accurate?
I know they have been for me. So yeah, they have been pretty much a match to what the mortgage creditors would pull. Yes, I do.
Okay. Can you use bank statements to verify rental payments if you do not use checks?
Yes, absolutely.
Okay. If liquid funds are low because you constantly add funds to non-liquid assets, will that greatly impact ability to be approved?
I don't understand that.
For a mortgage. So if liquid funds are low because you constantly add funds to non-liquid assets, so maybe they're putting money in their 401k. It's not liquid. Will that greatly impact ability to be approved by a mortgage? Will having a higher credit score than required for IA programs like 780 positively affect the application process, or does it not matter once your credit score is above the requirement?
Well, if you have a high credit score and your DTI is reasonable, you may not need reserves. It's going to whatever the system tells us. But typically, if you have a high credit score and your DTI is not excessive, then it doesn't usually call for reserves.
Okay. So does Invest Atlanta incentives work for conventional loans? Does Invest Atlanta incentives work for conventional loans? I'm referring to home buyer assistance programs. So yes, we will do conventional loans, but please come back and visit us 3 weeks from now. Please apply, register for that workshop as well, because we'll get into the details of that. Okay. What is the DTI percentage we should arrive for? Above 45%? I'm not sure what that means.
No, you should probably keep your DTI under 45.
Right. Okay. Would you recommend using a third party like RentTrack to report your rental payment history to the credit bureaus to help boost credit score?
I'm starting to see that a lot. So if it'll boost your credit score, I'm all for it. But yes,
Right.
I am starting to see that quite a bit now.
Okay. I have 6 months employment history, 2 months laid off due to C-19, working now for 2 weeks, no debt. Should I wait before applying for a loan, and why?
Is it the same? Did you go back to the same job, or is it a different job? And then we want to know what's the likelihood. We're going to look at what profession you're in. If it's one where you could likely get laid off again, or,
Right.
we probably wouldn't look too favorably on that. Because we are looking at what industry are you in and how is it affected? Because that will affect
especially with COVID-19, it's affecting very specific industries. So I definitely get that. Okay, on my FICO.com, I received a score. Should I have received score and report?
I don't know. You have to ask my FICO that.
Right. I'm not sure what they're providing.
Yeah, because with those they have all these different boxes you can check. So it just depends. But
and also, important to understand when you're getting the free version of anything, it's not going to be 100% complete. It's not going to, include everything that could possibly be available. It's just not. They're going to want you to pay for something. So everything before that was inconsistent. I'm sorry I didn't send it all together. That's Ms. Washington asking about the employment history. Okay, so she says different job. I'm in nursing. Georgia is not an at-will state, so Georgia is an at-will state, so any of us could get fired at any time.
Right.
Yeah. Okay, so let me now, that was, I think, the end of the Zoom questions, but now let me go over, because we had some Facebook Live questions as well. I'm assuming folks are still on, so let me see here. Okay, can a person with a 670 credit score and Social Security income of $20,000 annually be approved for a home loan?
Depends on what other debt they have. And so it's all about their debt to income ratio. Take that 20,000 divided by 12, you got your monthly amount, slice it in half, Take the stuff that comes up on your credit report, deduct it, and what's left is what can be applied towards a mortgage.
Okay. If someone has a bad credit score and wants to be an authorized user on someone else's credit card, will that negatively impact the card holder's credit?
No, they don't look at your credit. They look at the card holder's credit.
Mm-hmm. So, can I change banks prior to getting a mortgage?
Yes, you can.
Okay. Can someone buy a house without using credit? I heard so, but can't remember the term.
Not from a regular institutional lender, no.
Right, you would probably have to buy it cash.
Right.
Okay. Mm-hmm. So lots of comments, Bonnie. Thank you, thank you, thank you. Great presentation. Can you use bank statements to verify rental payments? Okay, so we talked about that. Mm-hmm. Can you use bank statements to verify rental payments? You did answer that, mm-hmm. right? Yes. I remember that. Okay. Will you repeat what you said about Red Trap? I heard the response that it was a good way to improve your credit, but I missed the actual product. I don't remember that. Red Trap?
Yeah, something like Rent Track.
Mm-hmm. Rent Track. Okay. Mm-hmm. Do you know anything about Rent Track? Because I haven't heard.
I don't know anything about it, but I've been seeing it lately on quite a few credit reports in terms of rental history being reported there to help with their credit score.
Okay. All righty. I think that is, let me check one more time. I believe that is all of the questions. Michelle, if you are monitoring, I don't know if anyone put a hand up, but all of the questions in the chats have been answered. So do you want to take it home, or you want me to do that?
I think we had one more question from Tamara Rice on Facebook.
Okay.
If I'm not mistaken. Let me see. No, I don't see.
Oh, she did say, yes, she did say, I see it, Michelle. Okay. Will my credit be increased by paying off my car?
Will your credit be increased by paying off your car? I'm not sure. I think it will. Yeah, I think it will. How much? I don't know.
Okay, hold on. I've got one more I may have missed, and let me just.
I see someone keeps saying my FICO is not free. I didn't say it was free. It's not free. You have to pay for to get your score at my FICO. There's definitely a cost.
Okay, so what I'm going to do is ask Denise, please write your question again, because there are 60 questions in the chat box. So let me please write your question again if maybe I missed it and it was higher up in the chat, and I'll get it answered for you.
And while she's doing that, let me just go back, because I saw it pop up about the My FICO. One thing you can do, and I just thought about this, is, most of your banking and credit unions send you, or you can sign up for that one free credit score that comes every month that you can track it. So if you take that one and you use it with Credit Karma, you can see what the difference is on a monthly basis. And then you can kind of track what you're doing to improve it, to see what effect it's having.
Okay. All right, so Ms. Denise did say, if a CD like self-lender counts as a credit card to build credit.
If it's reporting on the credit report, yes.
Okay. Mm-hmm. Gotcha. Okay. I think we've answered all of the questions, Michelle.
One more.
One more.
In the chat. You see that one?
Which chat? Look, I'm like, which chat?
The Zoom chat.
There we go. I see it now. Okay. How will applying for pre-qualification with different lenders affect credit? That's a great question.
Okay. So when you're applying for a mortgage, you have a 45-day window. Okay. So the first day that first lender pulls your credit, that's day one. So you can shop as many lenders in terms of credit pools, and it will not affect you until day 46. It becomes a new credit pool. But when that first credit pool on day 1 hits 30 days, that inquiry will hit. But you won't have an inquiry hit from all the other lenders within that 45-day window. You go outside of 45, it starts over. You get it pulled again on day 46, that becomes day 1, and that's a new inquiry hit.
Gotcha. Anything else you see? Anything else? Anyone else, Michelle?
I don't.
All right, that was awesome. I think that was awesome. Thank you very much, Bonnie.
Oh, yes. You're welcome. Thank you. My pleasure.
And thanks to everybody. Thanks, Anita, for jumping on. And Kirsten, and this was a very last minute thing for us. But we wanted to make sure that we celebrated Home Ownership Month. Somehow, usually we have this huge open house walking tour, but that wasn't, a possibility this year. So we do have the series, and it will continue. Next week, we will go into how to choose a mortgage lender. The third week is how to choose a real estate agent. And the fourth week, we'll talk about our down payment assistance, our home buyer incentives that people love to use. So if you have not registered for those, you can go back to our website and registers for those. And it's going to be about the same thing, about an hour and a half to 2 hours, going over this information and allowing you all to answer questions or to ask questions for us to answer. So I really hope that you all enjoyed everything. I appreciate you again, Bonnie.
I just saw someone pop up and wanted me to answer the last question again about the impact of multiple pools. Is it okay if I go ahead and read?
Sure, absolutely.
Okay. So when you apply for a mortgage, you have a 45-day window to have your credit report pull. Now, with any inquiry, it's going to hit within 30 days, but you won't have inquiry hits for multiple mortgage pulls if it's done in a 45-day window. So you have 45 days to determine who you're going to use as your lender in terms of having your credit report pull without it negatively impacting your score other than the one initial pull. So on day 1, you can have a lender pull your credit. In 30 days, you will see a slight reduction in your credit score based on that inquiry. But if you have another lender pull on the 10th, another one on the 15th, another one on the 30th, another one on the 42nd day, you will not see a reduction in terms of inquiries. Now, sometimes people will say, because again, as long as you stay in that 45-day window, when you get outside that 45-day window and it's day 46 and you get another lender to pull, you're going to get hit again with an inquiry because you started to cycle over. But if you stay within that 45-day window, you're fine. Now, you may, if you're going all across town and then a lender pulls and everyone like, well, gosh, why did you apply everywhere for a credit? So you have to think of that impact from just looking at it as an underwriter or a loan officer. What is it exactly you're looking for? So I tell people when you shop and you're trying to shop for a mortgage or a lender, because it's more important who you're working with, because most of our guidelines, most of the fees, most of the programs are all the same. There's not that big, huge of a spread. So the important thing is if you're doing these programs, to make sure that you know who does the programs and who does them well, because not everybody does them well, okay? Also, not every lender will do down payment assistance on a conventional loan. So you need to know that as well, because some will only do FHA. So you need to understand that. But more importantly, because we're bound by a margin on which we can, in terms of points, fees, and interest rates, we're all bound by a certain margin. So those days of lenders taking advantage are gone, okay? So, some people call me shopping for an interest rate because that's what they're basing who they're going to use on, and that is the wrong thing to do. Because you can get quote an interest rate of 3% and then go next door and get quoted 4%, and the 4 be better because it's about the total cost of the loan. What are all the costs associated with this loan? So You know, sometimes I had one time a client go somewhere else because they got a lower interest rate, but guess what? They paid 2 points to get it. Now they would have paid me the same 2 points, they would have got an even lower interest rate. So you have to know how to shop. And when you're shopping and you're looking at interest rates, you need to look at the APR, the annual percentage rate. Will vary from the interest rate because it tells you the total cost of the loan. So you need to understand the total cost of the loan. But if you're, again, it's not going to be that big of a difference. So if you go somewhere and they may be, I don't know, a quarter better and you choose to go with them, but they can't get your loan through the process in terms of understanding the down payment assistance and the little quirks and things that may help you through it, you just lost out on $14,000, $20,000 for a quarter point difference. Doesn't make any sense. So you have to evaluate the total process, okay? Who are you dealing with in terms of doing your loan? What is their closing ratio? Do they do the programs that you are looking to use for your down payment? So you have to make sure that those questions are asked as well and really understand what is important to you. So that's it.
All right, the last two questions is about points. Bonnie, person would like to know what you mean by pay 2 points.
Well, okay, so there's various interest rates, okay? And you can get a lower interest rate if you're willing to pay to get the lower interest rate. And that's called a bona fide discount point because it is real. Based on where your credit score is, if you want your interest rate to be lower, you can pay to buy it down. No, not buy it down. You can pay the discount point to get it lower. So there's a spread of interest rates. There's not just one. There's a spread, especially right now on FHA loans. Oh my God, it's just a huge variation. So, you know, it may say based on your credit score, the best interest rate for you is 4%, and it doesn't cost you anything. That's called a par rate. It doesn't cost you anything. But if you want to get 3.5, it may cost you a point, and a point varies. So it may cost you a point to get that rate. Typically, a point could be the 1% of whatever the loan amount is. So there's a cost if you want to get the lower interest rate.
Right.
And especially if you have lower credit scores, it may be to your advantage to do that because sometimes it means the difference between an approval and a non-approval. The lower rate will help your DTI. So there's different options.
Thank you so much. Someone asked how to register for the upcoming meetings. And if you were, well, obviously you registered through Eventbrite to get to this. We are going to send out information to you again about the remaining 3 sessions. And so you'll have an opportunity to register that way, or you can register by just visiting our website. You may notice us on Facebook or Twitter. There's a link to register that way as well. So I thank you all.
When the registration is full, they can always join on Facebook. Just make sure, you know.
If the registration goes full, I'm going to, we didn't know we had the capability to do this until just really today. So late last night today. So now that we know how to do this and we can do this, I'll make sure that the confirmation page that you get when you register will have the Zoom information on it and the fact that you can join us via Facebook. So this was our first kind of pilot run. The rest of the meeting should be really easy because I'm feeling a little more comfortable here. So we should not have a problem reaching out to you to let you know how to join us next time.
One last question, guys. Can seller concessions pay the discount point?
Absolutely. Yes. You can use the seller pay closing costs to go towards your bona fide discount points. Yes.
Now listen, you guys, I'm going to share this screen one more time. I want you to have Bonnie's information so that, where are we, Bonnie? So if you have any questions.
There you go.
Let me see. I want to make sure I'm doing this right though. Oh, I need to go back. There we go. So if you guys can see that, you'll see her email address there at the bottom, www.bonnielstewart.com. If you guys want to write that down real quick. And you can always reach out to us. We have Bonnie's information as well. So we'll be happy to share that with you. Mm-hmm. Thank you all so much for joining us tonight. This was great. And I didn't see Felicia. Felicia hung out with us anyway, despite her husband's birthday. I appreciate you for being here too. Thanks to the
Absolutely.
team, the squad. And
thanks to our other Invest Atlanta colleagues that are on the line. Daphne, yes. Thank you so much.
Thanks,
appreciate
Daphne.
the support.
Thank you so much, Bonnie. Again,
you're welcome.
Thank you enough. Thank you so much. Mm-hmm. Y'all have a great night.
Good night, everybody.
Good night. Thanks, Bonnie. Great.
Thank you. Bye-bye.
Shakira White. You muted. I'll call you.